Good afternoon and welcome to today's webinar on Sustainability-Linked Bonds, organised by the Hong Kong Green Finance Association, Bond and Product Innovation Working Group, co-chaired by Ricco Zhang from EMEA and Oliver Menard from Natixis. My name is Jenny Lee, the Undersecretary for Hong Kong Green Finance Association. Before we begin the session, just a few words on housekeeping. This webinar is recorded and broadcasted live on YouTube, and it will be available on the HKGFA website. During the webinar, you'll be able to post your questions on the Q&A box and also in the chat. And so I now pass the floor over to Ricco to introduce the session.
Thank you very much, Jenny. Let me share my screen first. Okay. Good afternoon, everyone. I'm very honored to introduce about this webinar, which is on Sustainability-Linked Bonds. It's a very interesting new product introduced from last year. Now we have seen a stable increase in the market, and this is a very good timing to further elaborate what's going on in the market. And we have an excellent lineup of speakers in the panel as well to speak from both sell side and buy side perspective. And special thanks to Sargent's team, and they have full information ready. And I just want to kick off the webinar by showing a very high-level overview about Sustainability-Linked Bond in particular, and what's the history behind the development. So as you know, the market actually started, the whole sustainable finance market actually started in 2007 when a few MBBs tapped the market with green or environmental themed bonds, or like a climate bond, green bond. Then in 2014, the first version of Green Bond Principle was launched. The green bond market now basically from that year just really developed and started to get attention from the market. Then in 2017, the social bond principles was introduced to the market. Obviously to focus on the social themed categories, and with both green and the social, ICMA also developed the SPG, the Sustainability-Linked Bond Guidelines, basically to cover both green and social aspects. Then in 2020, last year, at the GBP AGM, we introduced this Sustainability-Linked Bond Principles. It's really a brand new product, shifted a bit from the use of proceed bonds, and try to contribute to the transition topic as well. And later that year, we also introduced such a climate transition finance handbook to really create theme the labels on the issues in particular. With the 4 products now, GSSS, overall, you can check out the statistics showing on the screen. First is it's basically increased every year, and in particular in last year with the COVID pandemic, we saw a substantial increase in the social and the sustainability-linked bond. And this year, thanks to the effort by the market, the SLB actually also increased a lot. And we think that the SLB actually is the right product for this transition contest. Then I probably will leave the details for Sargent's team to basically to give a really comprehensive introduction about what is SLB, but overall, I think this is a little bit different from the other sustainable finance products family. It's not a use perceivable bond, and it has KPIs and SPTs as a target, and the bond will link to such target, and there's a lot of focus on disclosure and also verification. On the the landscape of the current principles, you can check that the use of proceeds bonds, which is green, social, sustainability bonds, is still very like a traditional as we probably have none already. The four core components, which are use of proceeds, process for project evaluation and selection, management of proceeds, reporting. We actually added two key recommendations for this year's new version of GBP, SBP, and the Sustainability-Linked Bonds guidelines. They are bond frameworks and external reviewers. Then SLB on the other side is a little bit different. They have like 5 components. One big difference is actually the verification actually is a must-have component to the bond. Then they are more like a financial instrument guidance. The labeling actually is about the product, but about the bond. While transition is more on the issuer entity side. The climate transition finance handbook we introduced from last year as well as a thematic guidance for the issues when they have commitment to the climate transition and that they need to show their strategy and the pathway how to achieve that. So here's the context of mine. If you have any questions, always reach out to me and ICM's team. So my presentation is just about a very high-level landscape about what's going on in the market. And I will leave the introduction to the Sergeant team. If I may, I hand over to Celine Massot.
Sure. Thank you, Ricco, and thank you to all the attendees. I'm Celine Massot. I work in SocGen Sustainable Bonds team. Before getting to the panel discussion, what we wanted to do is just do a brief presentation of what are SLBs, what is the status of the SLB market, and also pick a specific transaction as an example to really dig down a little bit more into details around how a second party opinion provider looks at that. So I will present that together with Federico Pezzolato from ISS Corporate Solutions. So just to start, and I may repeat some of the points mentioned by Ricco, so sustainability-linked bonds, or also what we call SLBs, are bonds for which, first of all, there is a financial or structural characteristic linked to ESG targets. So it can be a coupon step up or an increase in the redemption price if a certain ESG target is not met. The second characteristic is that these bonds are typically general corporate purposes bonds, and these are really the main differences with the so-called use of proceeds bonds, so what we call green social sustainability bonds, where, as some of you may know, these bonds typically finance specific green or social projects. Now, in terms of ESG target, what we mean by ESG target is that if we look at the market, the majority of SLBs that have been issued to date either have environmental targets, so it can be, for example, a reduction in CO2 emission, or social targets, or a combination of both. We don't see really a lot of SLBs being linked to ESG rating, and this is really a reflection of investor preferences. What is interesting is that when the EMEA SLBP were published, there were those SLBPs where the intention was not to be too prescriptive around what the targets should be or what the financial penalty reward should be. But we'll comment later on what are the key market characteristics. Now, there are two ways that issuers approach SLBs. You have those issuers who may not have been able to consider use of proceeds bonds, either because of the sector or because they didn't have enough eligible assets. And so they view SLB as an alternative to use of proceeds bonds. But interestingly, you also have issuers who consider SLBs as complementary. And that is something that we have seen quite frequently, where we've seen issuers who had been active in the use of proceeds bond market also now considering SLBs. The reason why is because it's also a way for them to make their commitments even more visible. From the investor point of view, and I will let our panelists comment on that in more details later on, but the way investors view SLB is that the benefit of SLB is that it's also a way to engage the whole company on the path, on the transition path, rather than just focusing on specific green or social project with an SLB, because you have those targets that are linked to the issuer sustainability strategy. It really forces the whole company to move. Now, in terms of standards, Ricco kindly mentioned the EMEA Sustainability-Linked Bond principles, and the SLBP have really helped the market to develop. Before the SLBP were published, there were very few transactions, and when the SLBP got published in June 2020, we definitely saw a boom in supply. The benefit of the SLBP is that it really provides recommendation on how an SLB should be structured, which information should be disclosed, and what kind of reporting should be done after issuance. If we look at most of the SLBs that have been issued to date, most of them are attached to a framework which is aligned with the SLBP, and all of them typically have an external review of the framework, which we call a second party opinion, or SPO. And those SPO will be supplemented by a third party review post-issuance of the KPI. Now, just to also give you a few data points in terms of supply. So it remains a small market. It's a market that is growing fast, but it remains a small market. We have just exceeded the 50 billion mark this year in terms of supply, so it's still very small. It's less than 10% of the supply that we have seen in the use of proceeds space. But that is, of course, normal because it's a market that only started in 2019 when we had the first SLB from the Italian company Enel. In terms of key characteristic, what we are saying is that the majority of SLBs that have been issued to date have coupon step-ups. We haven't seen much structure with what we call a reward, typically a coupon step down. So most SLBs have a penalty structure where either the redemption price or the coupon will step up if a target is not met. Also, in terms of targets, the majority of those SLBs have environmental targets. There are actually quite a few SLBs with social targets. And this is also a reflection of sometimes the expectation that the SLB should really tackle the most material issue of a company. In terms of tenor, we tend to see slightly longer tenors in SLBs compared to use of proceeds instrument. Slightly, it's not a huge difference, but slightly. And in a way, this is normal. It's because, as you can imagine, as a company embark on an SLB, the idea is to choose KPIs, so key performance indicators that are in the issuer sustainability strategy. And most of these targets typically have a timeline which can be quite long, so something around 2030. Sometimes it's shorter, but most of them have a target in 2030, which also constrained a little bit the choice of tenor that you can have. Finally, a final word in terms of market supply. In terms of types of issuer that we are saying, it's very different than the use of proceeds bonds, where in the use of proceeds bond, we've seen large supply from public issuers, large supply from financial institutions. In the SLB space, it's a market that is heavily dominated by corporates. We haven't seen yet any public issuers. We have seen a few financial institutions. The reason why we don't see a lot of financial institutions, there are two reasons for that. One of the reasons is that because of the fact that for an SLB, you need to pick KPIs that are material and relevant to the issuer. As a bank, for example, when you have a very diversified lending portfolio, it can be more challenging to pick a target that is deemed as relevant and material. The second main hurdle for financial institutions is related to regulation. Some of the SLBs, at least the structure that we have seen to this date, are not always compatible with some of the regulatory requirements that banks have, for example, TLAC. And so this is why it's a market that so far has been really dominated by corporates. But what is interesting is if we really focus on corporates, there has definitely been quite a large number of strategic sector in the energy transition that have been accessing this market. So we're thinking about, for example, oil and gas, cement shipping companies where in the past, it could have been more challenging for them to access the sustainable finance market, but now SLB really allow them to access this market. So before handing over to Federico, we wanted to also talk about an interesting transaction. So the Alstom Euro Sustainability-Linked Bond that was issued in November 2020. So Alstom it's a Swiss cement company. This transaction is interesting. So Societe acted as joint structuring advisor on it. And this transaction is interesting for multiple reasons. One of which is that it was the first transaction in the building materials sector, but also one of the first transaction from a carbon intensive sector. This transaction was really structured in line with best market practices, aligned with the SLBP. It featured an SPT defined as the amount of CO2 emission per tons of cementitious materials. The target was validated by the SBTi as aligned with a well below 2 degree scenario. And most importantly, the framework was also quite detailed in terms of the emissions coming from scope 1 and 2 and 3, which allowed investors to better assess why this specific target was material. Now, for this framework, Alstom obtained a second party opinion from ISS. And on this note, I will hand it over to Federico so that Federico can also comment on how SPO providers typically approach SLBs, and in particular, in this case, for Alstom.
Thank you, Celine, and thanks everyone for your attendance today. Indeed, well, there are a number of elements that I would like to echo from the introduction provided by Celine. It's true that we have seen many more issuers coming to the market, especially from hard-to-abate sector that typically were excluded from the classical use of proceeds structuring. But with the appearance of the SLB principles, indeed, also the world of sustainable finance became accessible to them as well. One of the elements that indeed is necessary according to the principle is the external verification on the alignment with the principles and the KPI materiality. So what we have done with Alstom and with all the issues that we assist when it comes to sustainability-linked transactions is to provide a second-party opinion considering 3 different elements. So we analyze, first of all, the KPI materiality and the level of ambition of the associated target, and we rely heavily on our internal expertise and the database that we have covering all the, more than 7,000 issuers belonging to all sectors. In this way, we have a very precise insights regarding the relevance of the KPI chosen by the issuer and the materiality for the company itself. And we can also opine on the fact if on the nature, on the core nature of the KPI. So if it affects core processes of the company, and clearly this was the case for Alstom, because scope 1 are absolutely a key topic for a company in the like also Lafarge Alstom. The other element that is assessed linked to the KPI is the level of ambition of the SPT. So we use different inputs coming from the company regarding past performances, but also we look at the bench at peers and we compare the performances with the other sector peers, and we look also at international standards alignment like the SBTi. But I think that we'll have the opportunity to provide more details on this assessment also later on during the discussion that will follow. So this is the first element of the SPO. The second element is clearly about the alignment of the framework with the principles. So after that we have clarified that the KPI is material and the level of ambition of the associated target is ambitious enough. We analyzed the entire structure of the framework in order to verify the alignment with the SLB principles. And the last element, but not the least important at all, is because it's really core in the structure of the sustainability-linked bond transactions, is about the issuer strategy. Because this is also an important element in order to analyze the materiality and the relevance of the KPI itself. So we check the issuer strategy in order to understand if the KPI is supported by an effective action plan in order to achieve the target that has been declared by the company. We look also at the importance of the KPI in the overall materiality analysis of the company, so that the analysis that the company has carried out for itself. In the case of Alstom, we had already a rating on the company, but the rating itself is not a necessary prerequisite in order to obtain the second party opinion. So clearly, in case the company is not present in our database, we can use the information provided by the company to provide an assessment on their strategy and check the alignment between the KPI and the overall strategy without any problem. By the way, a final note on the methodology and the type of process that is implemented in order to deliver the SPO. I would like, in some cases, there are the misconception that the SPO is just an approval, a stamp on a framework that has been already defined and decided. On the contrary, what is quite common, and I would say it happens for every single transaction, the external review process is an opportunity in order to improve also the framework and to fine-tune the trajectory, for instance, of the targets to be achieved and so on. So it's a really interactive and iterative process between the analysts providing the second party opinion, the issuers and the banks assisting the issuer in order to improve overall the robustness of the framework and the ambition of the operation itself. And it's based on a continuous exchange of information. This is what he did indeed with Alstom, starting from the framework, that is the core document that we analyze, but then there is the opportunity during the process to gather much more information and to refine further the documents of the framework itself. Thanks.
Thank you very much, Federico, for this very detailed explanation. I will now hand it over to my colleague, Ronald Young, who will moderate the panel with all our very interesting panelists.
Thank you, Celine and Federico. Hello, everyone. I'm Ronald Young. I'm a director at SG's SocGen Sustainable Finance team based in Hong Kong, covering the Asia-Pacific region. I'm more than happy to moderate today's panel discussion to talk about the SLB market and the structuring considerations for SLB. And today, I have the pleasure to welcome the three speakers on the panel. We have Jonathan Drew, who is the Managing Director of ESG Solutions, Global Banking at HSBC. And we have vanceFederico, who is the Director of Fixed Income at BlackRock Singapore. And we have Federico, who has just presented to you. Federico is the Vice President, Sustainable Finance Business Manager, EMEA and APAC as ISS Corporate Solutions. So welcome. So as we can see from Ricco's presentation, there have been exponential growth in the SLB volumes over the past year or so. And this is primarily driven by European corporate issuers. So maybe I'll first come to Jonathan. So Jonathan, do you expect the SLB market to grow at the same pace in Asia?
Ronald, thank you for the question. And thank you to the GFA for organizing and for inviting me to participate. Well, at the risk of appearing slightly defensive about our business here in Asia, I was looking at the numbers, and you're right. Clearly, the sustainable bonds markets in Europe are bigger than the sustainable bonds markets in Asia. But actually, when you look at the SLB segment, and back to the numbers I think that both Ricco and Celine referenced, I think that sort of 50, 60 billion of SLBs that we've seen globally is about 8%, a bit less than the 10%, as Celine said. Actually, in Asia, I think we're at about 7% of our Asian sustainable bonds are in SLB format. On our count, we've had nearly 30 trades across Asia. So I think in a sense, the Asian sustainability-linked bond market has really grown in step with the overall sort of use of proceeds plus sustainability-linked market. So I think the answer to my answer to your question would be I'd expect that to continue, Ronald. I think we've got we've got vibrant sustainable finance markets in this region. I expect they will grow. I wouldn't expect their growth to be, frankly, any less than we're seeing across the rest of the world, and obviously that they are indeed coming from a lower base. I think we've seen all of those things that Celine talked about and Federico talked about in terms of sort of diversity of issuers. I think we can see that here in the Asian markets as well. We've had retailers out, we've had engineering companies, we've had banks, we've had cement. It's not just Holcim out of Europe. We've had Ultratech out of India, and we've had real estate. So again, we've had this sort of good diversity. I think the product has great merit and great value here in the region, frankly, as much as it does in the rest of the world. So I think I'd expect to see that continue, Ronald.
Great. Thanks, Jonathan. I'd like to seek the investor view now. So Van, do you see increasing SLB supply from Asian issuers?
Hi, Ronald. Thank you for the invitation to be on this panel. At BlackRock, as an institution, we have been very vocal about the fact that we see sustainability risks and climate risks as investment risks. So naturally, when you look at the sustainability-linked market, you see companies that are becoming more transparent with their reporting and targets for some of their material ESG issues. So we definitely welcome that. And when we also look at sustainable investing in fixed income, it's quite unique compared to equities because we have all these, we have the labeled bond space, right? We have the use of proceeds bonds. We have the topic of today's discussion, sustainability-linked bonds. And in general, we have to say that we love innovation in the ESG labeled bond space, and we support and encourage underwriters and companies to innovate and come up with instruments that excite investors. Now, if we look at the green, social, and sustainable bond market, we are very pleased to see that this market has evolved from a supply-led market to a demand-led market as more and more of our end investors want to allocate capital to such opportunities. When we turn to the SLB market, we definitely see this as the potential to be applicable to any sector and issuer, something which a lot of the previous panelists mentioned. And when we think about dedicated ESG portfolios, we think that these bonds can definitely augment the diversification of the portfolio when it comes to industries, and it can really provide capital to emerging market companies on their transition journey. So, when we even look at the historical issuance stats, this is something which Celine mentioned. We are already seeing a much more diversified market. So, when it comes to our Asian companies that we are having conversations with and some of our broker relationships, we are definitely seeing a rapid pickup in interest in issuing such bonds. We are seeing rapid pickup in interest in what are some of the material KPIs. So based on some of these discussions, we definitely expect the market to continue to grow at a healthy pace. What I would also caution, though, is when you look at the green bond market, you've seen that financial markets thrive on standardization. And for SLBs, we recognize the need to ensure further improvement in market standards when it comes to the rigorous choice of KPIs, the targets for these KPIs, and the financial structure.
Thanks, Ben. So, we have seen the growth, and there's a consensus that the market will grow. So maybe, Jonathan, coming back to you, could you give more colors on the key drivers for the growth? And what do you see as the drivers for the market to grow further?
Yes, I think my answer to that would really sort of pick up where what Ben was talking about in terms of thinking for issuers in this market, perhaps going through that process of thinking about sort of measuring their impact, and then sort of setting targets, then going on to think about, well, then let's create some financial incentives around achieving those targets. There's a sort of a natural process there. So I see that as a driver, as more companies want to demonstrate their commitment to not just their financial stakeholders, but all of the stakeholders in their business. I think the other thing, of course, to remember with the sustainability-linked bond market is, and there's a contrast here really with sort of the loan markets, and I think as most know, the loan market sort of adopted the sustainability-linked approach a little bit earlier than the bond market, where the sort of incentives, there was this reward. You could get a margin reduction if you meet your KPIs in the loan market, but obviously to date in the bond market, for I think reasons that are well known, that tends to work as a step-up structure. So if you're an issuer and you're doing an SLB, you're not doing it for the opportunity to avoid the step up. You're doing it because you want to demonstrate your commitment to the challenge and to the theme, and because you really want to engage with your financial partners and with investors as to why they should see you as a leader and a winner in your sector, in your business, as you go through the transition process. And I think as societal expectations, whether it's set from sort of government policy through to regulators looking for increased disclosure, or whether it's general societal expectations of expectation on corporates to be delivering and supporting society's ambition to address this huge challenge around climate and more broadly, that'll cause more data. More people will want to go out and need to demonstrate, keep banking, keep investing in me, keep bringing me capital at a competitive price. I'm responsible. You'll be demonstrating good stewardship if you place your money with me. Those are types of things that are really driving issuers and prospective issuers across a whole range of different sectors. And of course, as others have said, and I won't repeat, you've got the flexibility with the SLB to really tailor and craft your KPIs, the one or two that you might use, to be very relevant to the ones that are relevant for your business and your particular ambition, your particular transition pathway.
Thanks, Jonathan. So maybe let's spend some time on structuring considerations. So picking up from what you just said, Jonathan, I think there are a lot of incentives for company to do SLB issuance. And what do you see are the biggest hurdles then? And what would be the maybe additional incentives other than what you've mentioned?
Well, I guess if maybe if we wind the clock back to sort of that middle of 2020, when the product was just sort of emerging. I mean, it's amazing. It was only that short a time ago to when we think about how far we've moved in that period. I mean, those early deals, NL, as Celine referred to, thinking, I guess the challenges there were, looking for it from the issuer's perspective, how do I pick the right thing? I want targets I'm confident in, how much do I want to issue where I've got penalties out there? Those were the sort of the challenges then. I think the challenges now, as we move forward sort of 18 months, 12, 18 months on from that, are thinking about how do I make sure that the proposition I'm putting to the market, I am best in class, because the market's moving so quickly. So questions that Federico raised then around the sort of the scope or the materiality of the KPIs, they weren't really problems in the earlier deals. Nobody's really asking that sort of question, but now they are. They want to see the sort of what are the material issues and how are those captured in the KPIs. So I know a lot of the work that Federico is doing is saying, well, this is a sort of a view whether that KPI, how material is it? So I think that's a big issue. And I know there's a question coming on a sort of a key topic here around structuring and thinking about what goes in those KPIs and that balance between sort of getting the materiality in the KPIs, but even where you've got other material impacts that your business has, and I'm sort of thinking often that comes through sort of scope 3, where you may not be able to or may not wish to put a target on it that links into the payout mechanism under the transaction, but you still do need to be demonstrating that you do have targets, recognizing the broader impact of your business. So getting that right, I would say, is the big challenge today for issuers. They're less concerned about the sort of, the step up. I mean, obviously they're setting the ambition. They're not expecting to pay those. Market is starting to define a sort of an acceptable, what's the sort of materiality in that incentive. But I think it's getting the message right in setting the KPIs, having the sufficient scope, and having the, again, to Federico's point, the right level of ambition in the targets.
Okay, thanks, Jonathan. So I'd like to have a Vance and Federico view as well. Van, would you like to start?
Yeah, sure. Look, I think going back to what we try to do at BlackRock, we definitely see market forces that are accelerating the reallocation of capital towards issuers and assets with positive sustainability characteristics, and in the process creating sustainability premia for such investments. So if you're an issuer, you want to get ahead of this trend and benefit from it. So there are quite a lot of significant incentives for issuers to consider SLBs in light of the growing investor focus on sustainability issues, right? So SLBs are not only the way to attract a diversified pool of capital, potentially due slightly longer tenor transactions, which was mentioned in the earlier remarks, but it's really a way to galvanize internal support and to use this as a marketing platform to all of the company's stakeholders, which is something which Jonathan touched upon, right? From bond investors, banks, equity holders, and all the other partners. Obviously, the choice of financially material KPIs with ambitious targets and appropriate financial structure is very important. And I think this is a comment that I would make a couple of times during this panel. The challenge that we see really is again, to echo what Jonathan said. Today there aren't really well prescribed standards for the choice of the KPIs and the targets. And we think there may be a little bit of a temptation for the issuers to seek the lowest common denominator available in the market, which in the long term can be counterproductive if you are seeing as a company that doesn't have ambitious sustainability goals, because those targets, once you set them up, and if you don't update them, they would be there for the life of that bond.
Okay, Federico, would you like to share your view as well?
Yeah, thanks, thanks, Ronald. Indeed, well, many relevant points have been raised already by Jonathan and Van. And regarding our experience, clearly working with a number of different issuers, one of the main benefits of issuing this kind of bonds is to diversify the investor basis and indeed attract new investors that are increasingly building their own ESG strategy and incorporating ESG factors into their allocation process, investment processes. So this is absolutely a great advantage that of this kind of transaction. The other element, indeed, is that was mentioned also by Celine at the beginning, is about the signal that is launched towards the market in general, because in structuring a sustainability-linked bond, the company is really launching a signal and putting skin in the game, demonstrating its overall commitments in terms of sustainability. Now, regarding the signal and the quality of the signal that is launched, there could be many considerations that we can do regarding the pricing of this kind of commitment, looking at the type of a step up that are present in the market so far, but I think it's important to recognize that we are still in a sort of testing and growing phase. Indeed, the market is really young, as Jonathan said. We have just been working on a few quantity of issuances so far. So issuers and investors are both working in order to build their own models. And indeed, when it comes to the main hurdles for issuers in order to structure a framework like that, one of the main elements is really the control of the data and the possibility to have reliable data that they can, on which they can have a real impact. And so the consideration, the discussion around scope-free emissions is really key, for instance, because it's for many issuers, scope-free emissions are a fundamental part of their overall carbon footprint, but still they don't have full control on that. So it's understandable that there is this kind of hesitancy to adopt targets related to scope-free emission, but still it's important to include this kind of analysis into the frameworks in order to demonstrate that the issuer is engaging and is comprehensively approaching all the topics that are material for their business. And talking about materiality, clearly in some sectors, indeed, it's more complicated than in others to find material KPIs and to build and to adopt KPIs that are also comparables with peers and so on. So once again, we will see probably further attempts in the near future to have personalized KPIs, making probably the life for investors more complicated in order to analyze the level of ambition of the KPI, of the targets, and also our life as an SPO provider, because clearly we are requested in this case to provide a very bespoke analysis. But I think once again, this is part of the evolution of the market, and going forward will assist to hopefully to some forms of standardized KPIs for certain sectors.
Mm-hmm. Thanks. So maybe let's dig a bit more into structuring features. So, we talk about the challenges for setting KPI and the importance to get it right. And we also talk about this whole thing is still under development. So there are lots of changes. But then can you talk more about how do we get that right? Assess the materiality in terms of assessing the materiality and relevance of the KPI. And then, you talk about customization of the KPI and how are these benchmarked? And then maybe do we see room for more social KPI as the S of ESG is gaining momentum? Maybe I'll ask Van to start sharing the investor views first.
Hi, Ronald. I think we discussed SLBs have 5 core components, which the ICMA has mentioned, right? KPIs, targets, the financial characteristics, reporting, and verification. At BlackRock, we have a very simple yet quite powerful framework to evaluate each one of those 5 categories using a 3-point scale. The framework, we call it ABC, where A stands for ambitious, B stands for business as usual, and C stands for contestable. When it comes to the KPIs, I think everybody on this panel has mentioned that the choice of the KPI needs to be relevant, core, and material to the issuer's overall business and of high strategic importance to the current and future operations. We often ask our investee companies to report under SASB and TCFD frameworks, and therefore picking these material KPIs from these frameworks is something that we often recommend. Obviously, the KPIs need to be measurable and quantifiable on a consistent methodological basis. They need to be externally verifiable, and you need to be able to benchmark these KPIs as much as possible, and ideally using an external reference such as a science-based target or a transition pathway initiative data. And this is addressing one of the questions that we have on the chat about how we actually go and prevent greenwashing. We think it's this clarity of the choice of targets and the reference to an external target. When it comes to setting the targets, especially for environmental goals, we definitely favor science-based targets. And we prefer companies to use this when setting up such climate-related sustainability-linked bonds. For example, when we do impact reporting for our dedicated ESG funds, we commonly reference the percentage of securities in the portfolio that are allocated to bonds that have science-based targets, and we provide preferential treatment to such securities in dedicated sustainability portfolios. And we also think decarbonization KPIs are easier to compare and quantify. We've been happy to see that I think about 60% of the market today in SLBs has seen such targets. Of course, there are a few sectors that have not yet their science-based targets finalized. So we recommend issuers in those sectors to stay on top of target guidance announcements as much as possible. Social KPIs definitely have a role to play, but we want to go back to the core principle behind the selection, right? These social KPIs need to be one of the most material ESG factors for the industry, and they need to be measurable and quantifiable. If these conditions are met, of course, social KPIs can definitely be used.
Thank you. So, Federico, I think your previous remarks already explained about the challenges and then like how to get a certain KPI right. Would you like to add anything in terms of like target setting?
Thanks, Ronald. Yes, indeed, regarding target setting, it's important once again, as echoing also what Van said, it's important that the company is able to provide a strong rationale regarding the adoption of certain targets, regarding not only the past performances of the company, demonstrating that there is still some good results to achieve and some good impacts to deliver in the future regarding certain the topics of the KPIs. But it's important also there is a benchmarkability of the targets themselves. And so this is strictly linked to the nature of the KPI. When it's extremely specific, clearly it's important that we are able, working with the issuer, to build a set of comparable peers that can adopt a similar matrix, and on the basis of that, we can also analyze the level of ambition of the target itself. And regarding the alignment with the international standards and the external validation system, absolutely, SBTi is fundamental, even if still it's not a prerequisite per se. So it's a very important support that we have when there is a target that is SBTi validated. Unfortunately, given the diversification also when it comes to targets, it's not always possible to have this kind of external validation. And so what we do in this case is to implement our own methodology, and especially the Sustainable Development Goals contribution system that we have developed internally in order to analyze the way in which the specific KPI adopted by the company can contribute or not to certain UN SDGs. And this is even more true when it comes to social KPIs, clearly, because we see that there is an increasing interest from issuers in order to incorporate also social KPIs. And this is true also for typically hard-to-abate sectors, because maybe they have a very important supply chain or procurement system, or a diversified, a very global activity in several countries. So it's important to monitor also social elements. Still, there are challenges in terms of benchmarkability, in terms of impact measurement, and so on. But once again, for sure, going forward, we'll be able to, altogether, all the market participants, to provide a solid rationale and build solid metrics also regarding social KPIs.
Yeah, thank you. And I'm actually conscious of time. We're approaching the end of the session, and I'd like to keep some time for Q&As. So maybe let's spend some time, a few minutes, on structuring preferences in terms of number of KPIs, observations, and incentive mechanism. So maybe coming back to you, Jonathan, what do you see these in the market?
I think we're moving very constructively, Ronald, to seeing a limited number of KPIs in most transactions. We might see borrowers stepping up, issuers stepping up their ambition by having even more, as it were, triggers that would drive the penalty. But I don't think we'll see, we won't expand to sort of 4 or 5 KPIs as we're now sort of typically seeing in the loan market. I think it'll stay probably 1, 2, maybe 3. I don't have anything to add on, the KPI setting to what Ben and Federico said. In fact, I think I'd suggest you take the transcript of those last 2 comments, give it to Ricco, and he can publish that as good practice guidance on the ICMA website. I think we will see that the time period is going to be critical. So a lot of people are setting very long dated ambitions, and then part of the challenge is then how do you set intermediate targets to bring it back within the life of the transaction? That's obviously a critical component. We seem to be sort of settling around a sort of a test date or a trigger date, sort of somewhere between a half and 3/4 of the way through the life of the transaction, so that there's enough of a period at the end for the issuer to suffer the pain, as it were, if they've missed the target. I think that feels about right. But I think I was going to make a, just a comment, sort of linking that back to the last question. I think the one thing we don't want in this market is we don't want regulation around what KPIs and should be and what SPTs should be. I think we've got a very healthy market today where we've got this openness, and the accountability comes from, if the issuer or the intermediary is putting a weak structure out there, well, there's Federico is going to tell you that. Or if you get to market, Ben's going to tell you that. We've got a very constructive set of sort of media and market observers around this market. You say, yeah, that really wasn't very good. That could have been a lot better. It's very constructive dialogue. So I think it's really important we preserve that going forward.
Great, thanks, Jonathan. So Ben, it'll be helpful to have your view as investors about structuring preferences. What do you see as like something that you want to invest in?
Yeah, I mean, look, I think the reality is when you look at the emerging markets and the financial characteristics, we think there is room for improvement when it comes to classifying some of that variation, i.e. the coupon step up as ambitious. In the vast majority of the cases, the financial penalties are only a very small fraction of the original coupon. And we oftentimes see a test date that is shortly before maturity or sometimes after the bond's first call date. So we don't necessarily think that the prevailing financial penalties today provide a meaningful incentive, financial incentive for the issuer to achieve those KPIs. But on the other hand, it doesn't mean that these targets are not relevant, because we actually think that the signaling factor and the public commitment to such a targets currently are playing a much stronger role in the likelihood of the issuer achieving these targets, right? So this goes back to Federico's point about the importance of these targets fitting well with the company's overall sustainability targets. On our wish list, we definitely recommend that issuers adopt and investors ask for KPIs that are tested through the life of the bond at various milestones, more financially material penalties, and testing that happens well ahead of traditional call features in the case of high yield bonds.
Thanks, Ben. So yeah, before we close the discussion and open up for Q&A from the audience, so maybe Federico, would you like to add the SPO view on structuring features as well?
Yeah, thanks, Ronald. Well, to be honest, we so far, given the infancy in general of the market, we haven't yet been called to opine deeply on the bond characteristics or the incentive mechanisms that have been adopted by the issue. So it's something that we'll see probably in the next year, because investors are refining their approach and also demanding more precise commitments from the issuer side. However, I think that it really makes sense to have for the issuers, if they want to build a solid SLB framework, to have a focus on a few, as suggested by Jonathan, on a few KPIs that are really material for their companies, in order to launch a clear signal to the market. And hopefully we'll see also going forward more precise trajectories, also with intermediate observation dates, in order to anticipate, also to check and monitor the advancement of the company on the achievement of the target. At the moment, there is this kind of public commitment, as Van has said, putting a clear deadline, but still in some cases the trajectory is not completely defined, and it's not linked to the bond characteristics itself. So on our wish list, we'd like to see this kind of more precise and timely intermediate milestones set by the companies, and in this way also the accountability towards the market will increase as well.
Okay, thanks, Federico. So we only have a few more minutes left, so I'll open up the forum for Q&As from the audience. So yeah, there are a couple of questions. Maybe I'll pick, let's pick this one. There's disclosure, is about disclosure of KPIs. So for SLB, do you see the opportunity in the near term of having some sort of common digital disclosure format based on XBRL, so easy to access and compare? So any volunteer?
I can try, and I let the others join as well. I think it's an interesting question. I think the short answer is that we know that some, let's call it, platforms are working on this, but I think that the challenge here will be about the standardization. I agree with what Jonathan mentioned earlier, where it wouldn't be really helpful to the market if for a specific sector you had only one or two KPI that was prescribed. At the end of the day, there has to be a little bit of flexibility. And so as a result, until you really have a clear, harmonized list of KPIs that applies to all sectors, all issuers, it might be challenging to have this kind of platform. But I guess we will see more of these common database, public database, where you will be able, as an investor, as a bank, as an issuer, to really consult the different frameworks of SLBs that have been published and consult the different reporting. Now, will it be easy to compare from the reporting made by company A to company B? Might be more challenging, because there's no certainty that company A KPI is exactly the same definition as company B.
Okay, thanks, Celine. So there's another one. So what are your views about an SLB that selectively incorporate only 1 to 2 KPIs when the issuer has a lot more KPIs, for example, like 5 or more within its financing framework? So is this allowed, or how do you see the cherry picking?
I'll have to take that one, Ronald. From the issuer side, I don't think it's about cherry picking. It might be that the issuer prefers to have certain KPIs in their relevant SPTs, sort of in the in the coupon payment mechanism, but the issuer may have other targets that it's set, where perhaps it has it's set them as targets, but they're more aspirational. It might not yet be so clear on the plans to achieve those targets, but it's working on them, and so they might quite reasonably, I think, disclose those, but not have penalties triggered against those. So I don't see this as a concern, and in a way, I think we should encourage issuers to also set sort of and disclose their ambitious targets, as well as have those that are formally triggers in the document.
Mm-hmm. Thanks. And here's another one. So there's one on greenwashing where Van has already answered. So that's another one is interesting one. So it's asking about the skills for market makers and evaluators. So what is the approach you implement to educate your frontline staff and loan officers to review the bonds that are being used for material aspects, and how are the impacts being verified? So maybe I'll ask the investors this question. So Ben, would you like to share your view?
Look, I think the question is a little bit, perhaps a little bit more relevant for the sustainability-linked loan market. When it comes to our evaluation, we do something similar to what we do for green bonds. So we have a dedicated team that are really experts in all sustainable finance, fixed income instruments. So they serve as the central body of knowledge about what are the various practices and what we consider acceptable. And we heavily rely on them. So when an issuer comes to the market, we have this specialized team. We have an ESG capital markets working group where we are constantly discussing what are the best practices in the market. So between the individual credit analyst who knows the industry very well and is responsible for the ESG analysis of that industry, between the capital markets group, which is well aware of global trends and can compare, let's say, wholesale targets to ultra-tax targets here in Asia, as well as look at the various financial coupon step-ups. To what are some of the trends in the industries when it comes to, let's say, climate. We are able to quickly formulate an opinion on whether this is a good sustainability-linked bond that we want to support and put into ESG portfolios or not. So this is the way. It really needs to be the combination of global expertise on some of these factors, as well as the people who know the company best.
Thank you, Ben. So I think it's already 5:02. So I think we're coming to the end of the session. So on behalf of the panel, I'd like to thank HKGFA for this opportunity. And I'll thank all the speakers for the insightful discussions. Thank you very much. So Jenny, I understand that you would like to make an announcement.
Oh yeah, no, great. Thank you. Again, echo Ronald's thoughts. Thank you so much to our distinguished speakers for sharing their technical expertise on the SLB market development characteristics and practical considerations. And before we close 2 items, I'd just like to highlight that HKGFA's annual forum will be on November the 30th, where the theme is financing carbon neutrality in Asia. Registration is open and I encourage you all to register. And also one final piece of housekeeping for HKGFA members. Thank you so much for completing the short survey sent on behalf of the Center for Green and Sustainable Finance on climate-related risk, data needs and gaps in the financial industry. If you've not received the survey but would like to contribute and participate, please do send us an email after this webinar. Thank you all.
Okay, thank you. So thank you everyone, and see you next time.